Good morning, everyone. I'm Dan Bosse, joined by our director in the Chicago office, Ben Buckner, and we're happy to be back. Have Ben back from London, so welcome home, Ben. Want to talk here a little bit about the grain markets. We had crop condition ratings yesterday, which were surprisingly poor. We were expecting maybe good to excellent ratings in corn to be somewhere north of 74%, spring wheat ratings north of 70%, and those ratings came in much lower. Spring wheat crop was rated 45% good to excellent. The corn crop rated 68% good to excellent. Next week, we get soybeans in terms of their ratings. So, I think a lot of the trade is trying to grapple with what the crop condition ratings mean. I know I personally had trouble in terms of looking at a state of Iowa that had a decade high 83% of its corn rated good to excellent. I go to the north in Minnesota where 69%, a 10-year low, is rated good to excellent. Then I go to the south, Missouri had 76% rated good to excellent, a high, a 10 record high. So, as you look about it, why does one state have good ratings and the state adjacent have such poor ratings? We believe at Ag Resource, it's all related to temperatures, and size matters in the initial crop condition ratings. And so it doesn't have much of an impact on yield. But Ben, I'm going to turn it over to you. You've got some data here. What do you think about condition ratings and what do we do in the markets going forward?
Yeah, it's very kind of a surprise. At least I think the issue for the grain markets, if we think about very short-term price discovery, we've talked a lot about volatility, chaotic weather forecasts, and I think it just kind of underscores the market today. Those questions about are we guaranteed trend yields is still unsettled, so it makes sense for grains to recover today. But I think longer term, it's still very early. And I think too the question about crop ratings in late May or early June is what exactly are we measuring? We've got a third of the corn crop yet to emerge yet, so it doesn't really tell you a whole lot. But I think that this provides some context. The graphics that you're seeing here, not overly robust corn crop health today, according to NASA enumerators, at least 68% good excellent versus initial ratings a year ago of 75%, right at the long-term average. So again, the blank canvas nature of balance sheets, at least today, probably still intact. We don't see any real threats, but we haven't answered a lot of questions with early season crop conditions. And the spring wheat rating, I think, was the bigger shock. Just 45% good excellent. North Dakota and Montana both below 40%, which to your point probably is cool temperatures. And even recent rainfall didn't help those young crops. But it's a low rating. This is kind of the second lowest since 1989, at least when we look at initial spring wheat ratings. And I think the question that the spring wheat market at least has unanswered today is, does this extend into the Canadian prairies? We won't know any of that for many, many weeks, but how wide is this area that is deemed to be rated pretty poorly? So that's, I think, what's driving the markets today, again, very short term. I think providing some context to this, though, is number one, look at the R squared when we put together initial good, excellent ratings in corn and final yield potential. It is very low to the point where this is mathematically kind of worthless. We can put this into quadrants, I guess below 60% initial good X ratings, higher odds of sub-trend yield, above 70%, pretty good odds of above trend yields. That's about all we can say. We're right in the middle. So this shows you if the USDA's yield is exactly correct at 181 bushels an acre, this still fits. So I don't think either the bulls or bears have much of an argument today, at least based on initial corn good to excellent ratings. Spring wheat, similar. I mean, this still kind of fits. If we assume the U.S. spring yield will be at trend, it's a little lopsided today, but I think that where the red dot on this graphic exists, it's still within the ballpark. I mean, I don't think we can say we're guaranteed to have sub-trend spring wheat yields, but we do need to watch conditions. I mean, as we get closer to later summer, this correlation improves. So if we don't see a big jump in spring wheat health, we probably got to dial in some measure of yield loss. But anyway, just wanted to tell you, most importantly, that these ratings have little to do with actual yield performance. And I don't think that's even terribly insightful, but just wanted to provide some background and a framework to this. And I think that our kind of assessment of the markets is maybe weather, the lowest of the hanging fruit. I think the forecast does look pretty good. We need this to verify, I suppose, but we're going to have the return of maybe heavy widespread rainfall in the 8 to 14-day period. NOAA agrees with this. And one of our theses at Ag Resource has been, because we've got so much rain in May, we've seen just incredible shrinking of drought coverage. Those are long range forecasts, which we were watching, were pretty concerning, have had been forced to dial back their odds of drought, at least for the first half of summer. So on the right, we have at least the most recent CFSV2 US North American precip probability forecast. So all of these long range forecasts on balance are trending wetter and less hot. So I think the odds of drought, at least for the next 30 days, 45 days, I think very, very low. And most importantly, Dan, I think to your point that, cool temperature is not ideal, especially how cold they've been the second half of this month. Warmth finally shows up probably June 1st onward. And so we're going to have probably adequate to abundant soil moisture in most places. We'll get the heat. I think that does allow for some counter seasonal jumps in crop rating. So again, both the bulls and bears unsettled by yesterday's numbers, but the forecast does look very good. And that probably acts as a weight long term. And to that end, I mean, this kind of reminds me of maybe something like 2019, where conditions were very low. We were having some supply issues, not nearly to the degree that we have today. But look at the other side of the ledger, and demand, I think, is what we are concerned about. I want to highlight, the Brazilian corn crop probably will be very, very big. Argentina's production kind of locked in; it also will be big. So as we debate supply, I think we've got to contend with the loss of U.S. corn export dominance about August 1st onward. The Brazilian cash market last night quoted at $5.30 per pound. It was about $6 per bushel, $6 per bushel 30 days ago. Seasonally, you see, we're probably not going to slide into lows in Brazil until July or August. So they will be competing. They will have corn to sell. And that's also what's different about the market compared to last year, and certainly compared to the last 3 months. The U.S. will struggle a little more mightily to find new export demand late summer. Wheat too, as low as the spring wheat rating was, maybe it's also, crop health in Canada is not any better. The Russian wheat market clearly looking for demand. Everything's kind of shifted to new crop. Eastern Europe and Russia are the low-cost sellers this morning. So we can debate supply, and we will do that for the next 100 days. But on the other side of this, I don't think we're going to find new export demand, or at least that will be a greater challenge moving forward. So the two pieces have to be put together when we think about long-term price discovery. And of course, we all know, most years, if there's not a major threat or perceived threat, seasonal trends do start to account for just the building of physical supplies, and that's where we think we're probably heading. So, Dan, rebuttal's welcome, but that's kind of where I see things this morning.
No, I think that's right, Ben. I don't have much to rebut. I keep going around in my mind that, the world is going to have an extra 32 to 36 million metric tons of corn outside of the United States. And USDA's new crop corn export estimate of 2675 is way too high. I would argue it's 200 to 300 million bushels too high. And with that, we end up with 2 billion bushels of stocks, and December corn above 450 is a sale. So no argument from me in any of that. We need a weather threat, or we need trade deals if we're going to change these markets. And at least for now, we just don't have any of that around. Any closing comments, Ben?
I don't think so. No, I think, again, a rally is probably going to be pretty labored, given the forecast, if nothing else. So again, it's very simple, but we don't see that threat. And again, I think it's the adjustments to even the long-range forecast. We've kind of talked about the Gulf of Alaska, et cetera. I just don't see much in the way of heat and dryness in the U.S.
No, thank you all. You can all take a trial of our Ag Resource services and our research on a more specific basis. Scan the QR code, and it'll be available at $1 a month for the first month for you. Thank you for watching today. Thank you, Ben, for your commentary. Good commentary. Welcome back. And we'll be back in coming days. But again, rallies are to be sold, at least today, looking at grain prices without a threat in terms of weather or a trade deal with China. Be well, everybody.
Bye-bye.